Last week, we found out that options are priced based on how and when information reveals itself, and more importantly, how valuable that information is. Options don't decay, uncertainty does. This week, if that's true, why do so many traders obsess about high win rates? The myth of high win rates. Traders love win rates. They brag about them, market them, and obsess over them. I win 80% of the time, sounds like skill. I only win 30% of the time, sounds like failure. People are wired to equate frequency with success. If something works most of the time, it feels reliable. And this instinct works well in everyday life. If your car starts 99% of the time, it's a good car. If a restaurant gives you good meals 95% of the time, it's a good restaurant. So striving for a high win rate sounds like an obvious goal. It's obvious and dangerously wrong. In markets, a high win rate isn't only unnecessary, it's often a warning sign. Markets do not reward frequency. Instead, markets reward something not quite so obvious. They reward payoff-weighted outcomes. A trader who wins 90% of the time can go broke, while a trader who wins only 30% of the time can become extraordinarily wealthy. If it doesn't sound possible, the disconnect arises because trading isn't about being right, it's about being paid. The win rate trap. If win rates were the only thing that counted, it would be easy to make money from the most unlikely place, a casino. Place a $1 chip on each of the 38 spaces on a roulette wheel. You've covered the entire board, so you're 100% guaranteed to win. That's the best win rate you could ever hope for. Sounds good so far, but let's see how the rest of the math works out. The casino pays $35 for winning on a single number, plus returns your dollar, for a total of $36. But wait, it costs $38 to play, so it's a loss of $2, or about 5.25%. If you continue playing, you'll win 100% of the time and always lose money 100% of the time. That's a good way to show that win rates can't be the whole story. So why would you always end up losing? The reason you lose with casinos is that they pay off at less than fair value. The weight of the $35 payoff isn't big enough to compensate you for the money you have at risk. If a casino were paying fairly, it would pay $37 for a winning number, not $35. That's a $2 shortfall, and that's why you'll always end up with a $2 loss if you cover the board. The more you play, the more you lose. But at least you can tell everyone you win 100% of the time. So win rates don't provide an edge. Win rates aren't the target. The real story is about being paid more money relative to the risk you're taking. That's the key. For instance, if casinos paid $38 rather than $35 for a single number, you definitely have a long-run advantage, even though you'd only win less than 3% of the time. The weight of the $38 payoff overcompensates you for the risk you're taking. Traders, however, never think about the long-run effects. Instead, they want to look at win rates. But if you only looked at win rates, you'd turn down a single number bet where you can win $38 and continue to play by covering the board where you can win 100% of the time and always lose. Markets punish framing errors. Probability doesn't just depend on win rates. It depends on the trade-off between the win rate and the payoff ratio. Win rate versus payoff ratio. The payoff ratio is simply the ratio of the probability of winning divided by the probability of losing. So if you can win 80% of the time, there must be a 20% chance to lose, which means the payoff ratio is 80% divided by 20%, or 4. Because you can win 4 times as often as you lose, the size of the loss must be 4 times as big as the bet. If a strategy can win $100 80% of the time, the market forces the loss to be $400 the remaining 20% of the time. The market always forces the expected payoff to be zero. In other words, if you played this game hundreds of times, you'd expect to break even. If not, it opens the door to arbitrage. So the expected value is a conservation law in finance, which means if a strategy offers a high win rate, you can be sure that large potential losses are hiding somewhere in that same strategy. That's the hidden side, the danger of high win rates. Expected value is what matters, but it's often invisible in the short run. You can't feel it, you can't see it. You can't even take a screenshot to post on Facebook. It only shows up over time. This makes the idea of expected value psychologically difficult to believe, especially if you have a high win rate. But make no mistake about it, the market allows a high win rate for only one reason. There's a high loss hiding somewhere. Markets don't care about how comfortable you are with the strategy. They only care about the math. High win rates create bad decisions. When traders focus on high win rates, it doesn't necessarily mean they're making good trades. At the first sign of a small gain, they close it just so they can chalk it up in the win column. The result is that they cut winners short, but still hold all the downside risk. They chop off all potential gains without any proportional decrease in risk. Just like playing roulette, you can make it part of your plan to bank any wins by locking them up under your mattress, but it won't make a difference. Just like many trades with a negative expected value, you'll get many wins, lots of small profits, and it'll seem like a stroke of genius. These strategies are attractive because losses are rare, profits look smooth, and traders feel in control. But the occasional loss is not an accident. It is the source of the profits that funded all the small wins. You're risking the future to feel good today. The illusion of naked puts. Options traders are especially vulnerable to win rate illusions. Selling an out-of-the-money put often has an 80% to 90% probability of expiring worthless. Selling an out-of-the-money put option often has an 80% to 90% probability of expiring worthless. This feels like a casino edge. But the premium collected is small relative to the potential loss. The market isn't mispricing probability, it's pricing severity. Low probability outcomes are expensive because they matter. Markets don't offer free stability. When traders say, "This only loses 5% of the time," they're ignoring the fact that the 5% dominates the entire expected value calculation. Consistency is often code for selling insurance, accepting tail risk, and picking up pennies in front of steamrollers. You may think you've stumbled onto an undiscovered black hole on Wall Street. The reality is you got in line for a rare catastrophe, and the word catastrophe tells you how the movie ends. Why do traders focus on win rates? If expected value is what matters, why does the industry obsess over win rates? Because win rates are easy to sell. They feel intuitive. They avoid math. They flatter egos and produce quick validation. Could you imagine if traders tried to talk to you about tail risk, risk-adjusted expected value, or risk of ruin probabilities? Who wants to listen to that? Win rates sell hope. Expected value delivers reality. Most traders would rather feel smart than be profitable, and markets exploit this preference relentlessly. Risk is not about how often you lose. It's not about how uncomfortable losses feel. Risk is about the size of losses compared to the amount invested. High win rate strategies often maximize ruin precisely because they disguise it. To make better trading decisions, always remember that markets price payoffs according to probabilities. Stop asking how often you're right. Instead, ask what's the payoff if I'm right and if I'm wrong. That slight shift in perspective illuminates most of the bad strategies immediately. Win rate is a cosmetic statistic. Expected value is a survival statistic. Markets reward those who understand payoff math, not emotional comfort. The trader who accepts frequent small losses in exchange for rare large gains may look foolish until the math asserts itself. The trader who boasts about winning most of the time may look brilliant until the bill arrives. In the end, markets don't care how often you win. They only care whether you deserve to. Next week, traders talk about profits as if they're proof of skill, but profits don't reveal the risk that was taken to get that profit. Find out more when I show why using profits to justify the risk and then using those same profits to justify stopping are big mistakes.